Chemical manufacturer PI Industries has reported a strong quarter with growth steered by a healthy show in the domestic market. Let us do a three-point analysis to really understand the key earnings fine print and the outlook on the company. 1. Key Q3 result highlights. Well, PI Industries has reported a healthy 20% year-on-year growth in the consolidated revenue with a decent show in both custom synthesis manufacturing as well as the domestic markets. Now, the domestic market also saw a 20% year-on-year growth due to good rabi sowing amid healthy reservoir levels, which actually boosted the volumes this time. Custom synthesis manufacturing segment, on the other hand, also saw a 24% year-on-year uptick on the back of commercialization and ramp-up in demand for new molecules launched by the company. Now, there was an improvement in the product mix as well and a slight moderation in the raw material cost, which enables a sequential improvement in the gross margins. Now, EBITDA margin remained largely flat due to an uptick in other expenses and also the employee costs. Now, the quarter also saw an uptick in tax expenses along with a higher depreciation, which ate away a portion of the net profit growth in Q3. 2. What are the other key observations in the results? Well, the acquisition of Isagro is now complete and also the financials of the company are expected to get consolidated from Q4 onwards. The domestic business of Isagro will be transferred to a subsidiary called Jivagro Limited, while the remaining businesses will be merged with PI Industries. Now, the board has also approved a fundraising plan via QIP for 2,000 crore rupees in the coming 2 months. The money raised is planned to be invested to scale up to the existing operations and also enable organic growth, R&D, and also for diversification into new verticals like pharma CSM, specialty chemicals and nutraceuticals through organic and inorganic expansion. The current coronavirus spread has actually been a point of concern for many agrochemical companies. Now, as per the management commentary, the company is also covered for Q4. However, if the spread is not curtailed post Q4, there might be some impact. However, the revenue dependency of the company on China is in single digits, hence the impact might not be a lot. There has been a temporary close down of the Jambusar plant as well, and now this can have an impact to the tune of 40 to 50 crore rupees in Q4. 3. What's the outlook going forward then? Well, the company has reported a strong quarter with a healthy volume surge as well this time. Now, the CSM business has seen a strong build-up and has also reported a healthy traction from the order book this time. We do expect this will continue going forward in the other quarters as well. We also expect the growth in exports to sustain. Now, ramp-up in sales of recent product launches along with new molecules lined up for a launch do suggest that the volumes are expected to improve from here on as well. Now, the stock has already seen a steady run over the last few months. At the current prices, it is trading at close to its 52-week high levels, valuing the company at 35 times FY21 estimated earnings, which seems a tad on the higher side. Now, the company's growth story definitely remains intact. Now, we at Moneycontrol Research would recommend to keep the stock on your radar and enter when there is a correction.